Welcome back to Power Lunch. Well, I've been just looking in the break at the Monetary Policy Committee meetings, and indeed today is the finalization of this week's meeting. We will have one more in the year, so the economists don't believe there's going to be much of a change in interest rates, but it's always good to hear what Jill Marcus, the Reserve Bank Governor, has to say as she'll be talking later this afternoon. It's one of those critical pieces of information that you can understand how the economy really is working. But when you dig down a little bit deeper, cash flow in South African households is deteriorating as living costs rise, and a weak job market has been taking its toll on income security. This is according to TransUnion, whose chief executive, Jeff Miller, is with us in studio to help us through your latest index. Maybe just if we move back a little bit, you do this quarterly.
Correct.
It's an index which to be low is not good.
Yes.
To the higher it is, the better it is. It peaked in 2010 at 63, I see from the notes, and it's now down to 43.4. So yet another decline. What, in a nutshell, is that telling us?
Yeah, so it's similar to the Coheso PMI index. So anything below 50 means consumer credit health is declining in South Africa. Above 50 means it's improving. And what we're really finding is this is a fourth straight quarter of a declining index. And what we're really seeing is two things. One, we're seeing credit defaults going up. So consumers are not able to meet their obligations to credit providers. It's up 13% year over year. It was up 13% last quarter as well. And then the second thing is inflationary pressures, fuel, food, all of those other things are also squeezing the consumer's wallet. Obviously, the economy as a whole isn't growing very quickly. So all of that leads to consumers that are under stress.
Jeff, what would you say is the greater impact on our local economy?
What is the greater impact?
With regard to South African consumers still under pressure, unable to pay their bills?
Yeah, I mean, so obviously the strikes haven't helped. I think the overall slow GDP is really hurting incomes overall. I think just as important has been the huge rise in unsecured credit over the last couple of years. So even consumers that have had jobs and have steady incomes have taken on a significant amount of debt over the last couple of years, and they're finding now very difficult to repay it.
You mentioned that there's some encouraging news coming out of this, that banks have taken a little bit more of a stricter approach when it comes to offering credit to South African consumers. Are we seeing evidence of this in the greater impact of this?
Yeah, so there's a good news, bad news. What we're seeing through our information, so when a consumer applies at a bank, the bank comes to us to assess that consumer's credit risk. We're still seeing a double-digit growth year over year. So that means consumers are still extremely credit hungry. But when we look at the number of accounts that are opened, that number's coming down. So what we are seeing is lenders are being much more strict around who they're granting credit to. So that's the good news. The challenge is there's been consumers that were granted credit, a year ago, 2 years ago, and they're still struggling to pay that debt off.
But are stricter controls enough? Doesn't this also have to do with mindset, in particular with the guys at the lower LSM market who don't understand the impact of these credit payments?
Yeah, I think consumer education overall needs a lot of improvement. We did some surveys with consumers. We asked them what their interest rate was, and not a single consumer could tell us what their interest rate was. They could all tell us what their repayment was. So I think there's a lack of understanding around what the cost of credit is. I think there's a problem with consumers using credit to buy discretionary products, jeans or TVs or other things that perhaps they can't afford. There's a number of factors that have really contributed to the problem, the problem state we're at now.
We know all of that, Jeff. We know that the consumers are spending money on things they shouldn't be spending on. Yeah. But where there is a bit of confusion in my mind is the banks' write-offs have been declining.
Yep.
So what they're telling us is that the bad debt experiences that they're seeing are actually a lot better. Is that because, or the difference between what they're telling us and what you're telling us, is it because you're looking at different market segments?
So it may be. So if we look at the performance of vehicle asset finance and we look at the performance of mortgage lending, actually that is improving. So those delinquencies are improving. What we are seeing the delinquencies increasing is in personal loans and in the microloan segments. So for a bank overall, that's 4 to 6% of their portfolio. So an improvement in mortgage could offset that. Also, it depends on what they've provided for, right? So if they've built in the cost of the product with very high delinquency rates, delinquency rates could still be tipping up, but they could still be okay.
So we've really got two banking markets almost. We've got the Capitec Able market, and no wonder the Mr. Market is getting really upset about those shares and those operations, where you're confirming there's problems.
There's problems.
Whereas the other markets, maybe higher income,
Yep.
people who've got cars, etc., are actually coming out of their issues.
They're okay. Yeah, I mean, it's not a marked improvement, but it is an improvement overall. And what we are seeing is, if you talk, or Capitec publicly stated in Q4 of last year that they tightened their credit policy. So a lot of these banks have started tightening their credit policy, not just recently, but 3-4 quarters ago. So their current vintage performance is much better than the loans that they wrote 12 months ago, 2 years ago. So they're still having problems with their back book, but their current vintages are performing much better because of tightened credit standards.
Jeff, but where did all of this start? As you mentioned, we're targeting 2 different markets here. Is it because of the keen focus on the lower LSM groups, or have the high earners just been a little bit more relaxed with their repayments?
Difficult to make a conclusion either way, but in our view, and we don't have income on our file, but we can impute income through some analytics, and what we're really seeing is it's the lower end of the market that really is under stress. The mid and the uppers that have mortgage bonds and vehicle loans, they tend to be doing okay. It's really those lower end consumers, and a lot of them have taken out. They're used to 30, 60, 90-day credit, and now they're finding themselves with repayment terms of 24 months, of 36 months, and is there going to be debt fatigue, right? So you don't mind paying your bills if you're living in a house every month, but if you take out an unsecured credit loan 2 years into it, what is your appetite to continue to repay that, seeing you've probably spent the money you got up front?
Gugu, this reminds me of a story that we did about a year ago, if you recall, in the wake of Marikana. And
yes.
When some of our colleagues at that time went into the city of Johannesburg, and they could get credit as though they were millionaires. They were offered a multiple of their salaries by furniture stores, by I guess you'd call them loan sharks. So at that bottom end of the market, the chickens are now coming home to roost.
No, and the concern is, what happens next, right? So the consumers that are quite desperate and are unable to access credit for even their daily expenses. So what's going to happen to them? I mean, do they go to the lender of last resort, to an unscrupulous lender? Does this kind of set them off, and now they default in all their loan repayments? So it's a tricky situation. I mean, I think the banking sector is well capitalized, so I don't think it's going to be a banking sector problem. Maybe there'll be individual banks that have more of a challenge than others. But the human interest side, the number of consumers that are significantly under debt is going to be a problem.
And if you recall, there were talks of a credit bubble or unsecured credit bubble. Would you say that's maybe about to pop or burst anytime soon, or are there still concerns regarding that?
Yeah, so I think there's been an increase in provisions by the banks. I think that they've tightened up their credit policy. As I said, the larger banks really, are not that exposed to unsecured in the greater scheme of things. So once again, from a lending perspective, there may be a bit of stress, but I would not call it a bubble. The real impact is, what happens with consumers and how are they able to deleverage themselves and get themselves out of a hole that they've dug them, that they've been thrown into.
So the question for an insider, which is what you are, is would you own or buy Able and Capitec stock?
Those are my customers, so I can't comment specifically. But
I mean, you're holding piles of things, so you can't go short on that.
No. But here's what I can say: is consumers are under distress, and I think they're going to be for some time. I don't see this, fixing next quarter or the quarter after. I think consumers are going to be in a fairly pinched space for at least the next year.
Thank you, Jeff. That was Jeff Miller, the Chief Executive of TransUnion here in South Africa.